The read on the list with Gary Kaltbaum. We got Steve Moore, Kathryn Rooney Vera. Guys, thank you all for coming on Saturday, no less. Kathryn, begin with you. This idea that once shrinkflation starts, it doesn't get to expandflation. So no matter what happens to prices, we might have to get used to this. What does that tell you?
Well, it tells you that companies are having a lot of trouble, Neil, keeping pace with inflation and passing on the rising costs. So they're doing what they can to keep their profit margins without having to impact too adversely the consumer. But the fact, Neil, is that that consumers already impacted. You know, we're seeing 8.5% inflation, 25% annualized inflation in food and energy costs, and real wages are negative. So the consumer's already feeling the pinch. Imagine on top of that, as in my house with my 5 children, you open up a pack of Oreos and it's half full. I mean, that happened last week. So certainly, you know, this is something that I think your reporter is right. You know, it's very hard to go back to refilling that package. It kind of reminds me of government, government power never wastes a good crisis. You know, it's very hard for the government to rescind or return the power to the people after it's taken on so much. And the same thing with government spending. You know, government spending has been out the wazoo. We have 12.5% fiscal deficit now. Yeah. We have multi-trillion-dollar packages that we're supposed to attack COVID. That's never getting retraced, Neil. Never. That's just becoming massive social spending. All of that's inflationary. So inflation, everybody, is not going anywhere. It's sticky, it's structural, and it's here to stay.
Well, the one mistake I see you're making, Kathryn, is allowing the kids to open up the cookies when I would scarf them myself and dole them out at my discretion, not theirs. But that's a whole other issue. Steve Moore, let me get your take on where this goes, because we're looking at an 8.6% annual inflation rate. That stunned everyone. One of the big reasons why the Dow tumbled almost 900 points yesterday. A losing week, I think the 10th and 11th losing week we've seen. So obviously it means that this continues. This was a jolt to the system. It's not slowing, quite the opposite. What do you make of it?
Well, by the way, Neil, I've noticed that they're putting a couple of extra ads in your show, and so we get less Neil and more advertising. That's inflation too.
Which is just what the viewers want, I might point out. But go ahead.
Yeah, exactly. I want more Neil. This is a crisis now. There's no question about it. The inflation is getting worse. It's not getting better. That report that came out yesterday, if you put that on an annual basis, you're talking about 13% inflation, not 8.5% inflation. So all this idea of it being temporary, what was the word they used, transitory, that we had peaked inflation. It doesn't look like we're there yet. And I do think that one of the other big concerns is what has happened with people's 401k plans. Their savings have evaporated. We've lost about $10 trillion of wealth over the last 3 or 4 months. And that means not only can people are the prices outpacing people's paychecks, it means now people are having to dip into their savings, their 401k plans to pay their bills. It's a very precarious situation. And the answer to your question, by the way, Neil, about what happened 40 years ago, Ronald Reagan was elected president. And within a year and a half, all the inflation was gone.
Well, of course, he had help with Paul Volcker, right? The Federal Reserve Chairman at the time, who was raising interest rates 1 full point at a time. It's hard to imagine. But that raises actually another issue for you, Gary. You've been warning about the inflation thing for quite some time. The Federal Reserve meets next week. The betting was, before any of this data came out, that maybe it would hike rates a half a point at the next meeting. Now I'm hearing more talk of why not 3/4 of a point to get really ahead of this thing. What do you see happening?
Look, I think it should be 1 point to get ahead of it and still be behind. Look, part of this is not just what you do. It's sending a message to the country. It's sending a message to the business that you are dead serious about attacking this inflation. And Neil, a year ago, we started noticing the shrinkflation in a few products. It's like everything now. And also, it's that bad. And the fact that nobody's really doing anything about it, the fact that they're so behind the curve, the fact that Janet Yellen this week said, I'm not worried about recession, when you have mortgage applications dropping through the floor, you have savings rates plunging, you have credit card usage skyrocketing, and globally we've lost $30 trillion of wealth in bond and stock markets. I don't know how we not go go into recession. And the worst possible scenario is a Fed having to tighten, force to tighten when they're in this situation. Normally, he'd be printing like heck right now during this situation. So very worried here. I don't think I've seen a backdrop this bad going forward in a very long time.
You know, you might be right about the bad backdrop, and I'm not trying to be a Pollyanna about it, Kathryn, but I'm looking at these strong airline bookings, record bookings right now, back to pre-COVID levels. I'm looking at the hospitality industry making money over the proverbial handed fist. Very expensive resorts booked solid. I get that after COVID, people want to break out, spend some money, and maybe this can't be sustained. But it's eye-poppingly obvious right now, restaurants are booked solid. So are we missing something here? Is that very strength being underappreciated?
That strength is fantastic and it's resilient, but we shouldn't expect it to last forever. There's something called the wealth effect, and we've seen the S&P drop 15%. Housing prices are starting to slow down in terms of their, double-digit impressive expansion annually. And the consumer has negative real wages, which means that inflation is outpacing the increase in his or her wages. So the combination, I think, of a negative wealth effect, negative real wages, consumer confidence is dropping precipitously. And combine that, Neil, with the tightening of financial conditions, the Fed has only increased 75 basis points. But when you look at the 30-year fixed rate mortgage, that's even popped, above 5%, even touching 5.5%. So financial tightening, financial conditions has a lag effect, and we should expect that to start to adversely impact the consumer over the course of the next coming months. So yes, the consumer has been resilient. Don't expect it to last forever. And I would add into the fact that as I think it was Steve said, savings are dropping. So yes, guys and gals are spending more, but they're spending more because things cost more. So when you see savings drop, the thing that concerns me right now, I think recession is inevitable. It's part of the economic cycle, but a rollover in the labor market is what is most on my mind, because that would bring forward the recession. If we see a jump in unemployment, if we see corporations that say, you know what, demand is slowing down, I don't need that 2 for 1. The Federal Reserve said there's 2 available jobs for every 1 unemployed person. Get out and find a job. If that drops and we get a rollover in the labor market, recession is imminent.
Well, all bets are off then. But right now, my wife can't handle and take this kind of alone. She can't keep this buying going alone. She's going to need help. But Steve Moore, let me ask you a little bit about this environment here, because if the Federal Reserve were to sort of up the ante, start upping the increases, keep them going through the remainder of the year, I was factoring in we'd probably get to a federal funds and overnight bank lending rate around the 3.5% range. It's got to generally mirror whatever the inflation rate is, so it would still be well south of where it should be. So if the Fed were to try to match that, wouldn't that drive us into at least a slowdown, likely a recession?
The Fed, I agree with the others that the Fed has been way too slow, way behind the curve on this, and they have to raise interest rates a lot more. But that's not the only thing that has to happen here. I mean, the reason I mentioned Reagan, you're right, Paul Volcker came in and lowered those rates. But remember what else happened, Neil? What did Reagan do? He cut regulation and he reduced tax rates. And what that did was increase the supply of goods and services. So, you need to obviously reduce some of the demand, but you also have to increase the supply. And so when you hear the Democrats talking about raising taxes, more regulations, more of the war on American oil and gas, those are contributing factors, major factors to the inflation.
All right, so Gary, real quickly, can the Fed orchestrate this? Because they're the only game in town, if you think about it. What do you think?
No. Again, I hate saying that, but you already have rates, the 2 years above 3%. The market's already doing that job, and you are seeing the numbers in droves that are going up. The wrong things are going up. Everything's wrong at this point in time, and they're just playing catch up at this point in time, and that's the shame of it.
All right. Well, I've lost my appetite for lunch later on, guys. So, touche. You did the trick again. Very good talking to you. I think. By the way, Gary's referring to the 2-year note. That's a closely watched barometer. It is back over 3%. That's a better than 5-year high. A lot of people see this as a preview of coming attractions, that rates will go still higher. The question is, does that very hike in rates lead to a slowing of the economy that brings everything down, including those rates? We just don't know. It's still early. More after this.